Welcome to The Explainer. Every company runs on money, but what does that money actually cost? Today, we're going to hunt down the one single number that answers that very question, a number that really unlocks the true value of an entire business. Okay, so valuing a stock is one thing. We get that. But what about valuing the entire business? Every factory, every patent, every employee, that requires a totally different lens. We need a single rate that accounts for both the shareholders and the lenders, and that's the puzzle we're going to solve today. So here's how we'll do it. We'll start by figuring out what we're looking for. Then, we're going to play financial detective and uncover what really counts as debt. After that, we'll slap a price tag on it, and finally, we'll mix it all together into our final recipe, the WACC, before we tackle a few tricky special cases. All right, let's kick things off. The first step is to just broaden our perspective. We're moving past thinking only about equity, and we're going to capture the cost of the entire financial engine that makes a company go. And here it is, the cost of capital. Now, this isn't just some abstract percentage on a spreadsheet. Think of it as the company's ultimate hurdle rate. Any project, any investment that can't earn more than this rate, it's actually destroying value. This is the one number that separates the good ideas from the bad ones. So, to build this cost of capital, we obviously need the cost of debt. But wait a minute. Before we can put a price on debt, we have to agree on what it actually is. And let me tell you, the answer goes way beyond what you see on the balance sheet. It seems pretty obvious, right? Just look for the line item that says debt. But in finance, the economic reality of a promise you make is so much more important than what the accounting rules call it. The real answer is a bit more interesting. To cut through all the noise, Professor Damodaran gives us this simple, brilliant three-part test. If a financial promise meets these three criteria, we're going to treat it as debt. So, number 1, is there a contract saying you have to pay? 2, are those payments tax deductible? And 3, if you miss a payment, are you in really big trouble? And this is where it gets real. We all know that bank loans and corporate bonds are debt. But think about a big retailer with a 15-year lease on its biggest store. It's a fixed payment they have to make, it's tax deductible, and if they stop paying, they get evicted and the business is toast. You better believe that's dead, even if it's hiding off the main balance sheet. Okay, now that we've found all the debt, the obvious stuff and the hidden stuff, our next mission is to put a price tag on it. Now, the critical thing here is that we are not interested in history. We don't care about the rate on a loan from 5 years ago. The only thing that matters is the current long-term market rate. If the company had to go out and borrow money today, what would it cost them? That's the question. The calculation itself is pretty straightforward. We start with a baseline, a risk-free rate, like the yield on a government bond. And then we add something called a default spread, which is just a little extra interest to pay the lender for the risk that the company might not pay them back. Now, finding that default spread, this is where things get kind of fun. If you're lucky, the company has a bond rating from a big agency like Moody's or S&P. You just look up the spread for that reading and you're done. Easy. But if not, well, you have to put on your detective hat. And here's why that detective work is so crucial. As Professor Damodaran points out, the huge majority of companies out there, they just don't have a public bond rating. So for almost everyone, we're going to have to figure this out ourselves. So how do we do it? Well, basically, we act like our own little ratings agency. You calculate a key financial number, the interest coverage ratio, which just measures how easily a company can pay the interest on its debt. Then you use a special table to match that ratio to a rating and its default spread. It's a synthetic rating, but it works incredibly well. This table is pretty much our decoder ring. It directly connects how healthy a company is to its risk premium. So, for example, check out that A rating. If a company's income covers its interest payments about 3 or 4 times over, lenders see that as an A risk, and they'll want an extra 1% for that risk. The safer you are, the lower that spread goes. Let's make this real with an example. The Brazilian aerospace company, Embraer. We'd start with the US risk-free rate. Then we add that 1% default spread we got from its synthetic rating. But because Embraer is a Brazilian company, we can't stop there. We also have to add another layer of risk for Brazil itself. All 3 of those pieces come together to give us the company's total cost of debt. Okay, deep breath. We've done the heavy lifting, we have a cost of equity, and now we have a cost of debt. It is time to put it all together in our final recipe. And here it is, the famous weighted average cost of capital, or WACC. You just take the cost of equity and multiply it by how much of the company is funded by equity. Then you add the after-tax cost of debt multiplied by its weight. Why after tax? Well, because interest payments are tax deductible, which creates this incredibly valuable tax shield. Now, here's a super important detail. For those weights, you cannot, I repeat, cannot use the numbers from the accounting books. You have to use the market values of the company's debt and equity. And why is that? It's because if you wanted to buy the whole company today, you'd have to pay the current market price for everything, not some old number from a report. So if we look at Embraer, we see that based on today's market prices, the company's funded about 85% by equity and 15% by debt. These are the exact weights we're going to plug into our final calculation. Okay, we have our main framework down. But, the real world of finance can be messy. It's not always so clean. What do we do with those weird securities that are kind of debt, but also kind of equity? Let's quickly talk about these financial hybrids. Well, there are two really elegant ways to handle this. For something like convertible debt, you literally just split it into two pieces. The bond part goes in the debt bucket, and the option part goes in the equity bucket. Simple. For something like preferred stock, which is a classic hybrid, you can just create a third bucket in your WACC calculation. No problem. And there we have it. By looking past the accounting labels to find what debt really is, pricing it at today's rates, and blending it all together with the cost of equity, we've built our composite cost of capital. We now have the single most important number for figuring out what an entire business is worth. And that leaves us with a final, kind of fascinating thought. The number we've so carefully built is incredibly powerful, for sure, but it's also tied directly to what the market thinks about the company's stock in debt, right now, today. It's a constant reminder that valuation isn't just about a company's spreadsheets, it's also about the ever-changing mood of the market itself.